Now, according to Deutsche Bank, there's been a huge amount of flows into the tech sector this year, who've seen over $40 billion in cumulative global flows coming into tech. However, with the Federal Reserve signaling higher rates for longer via the dot plot on their Fed meeting last week, you can see that expectations have moved up across the board for higher rates, apart from the November 2023 median dot plot, which has remained the same, which is signaling one rate hike in November, but it's higher from 2024, 2025, and in the longer run. The Fed was emboldened by stronger GDP data out of the US. You can see in June they projected it to be 1%, and now they're projecting it to be 2.1% for 2023. And that's emboldened the Federal Reserve to have a higher rate path for longer to make sure they deal with inflation. Now, looking at the NASDAQ from a seasonal perspective, it does have a pattern of weakness during September generally, and specifically, there's been an average fall of 1.43% between the 26th of September and the 8th of October over the last 15 years. Now, will those falls repeat themselves again this year with a higher interest rate environment, with a seasonal pattern of weakness, with such a stretched and a long exposure into tech stock? Is there now time for a tumble in tech in anticipation of a potential recession in the US early next year? Major trade risks. Well, the major trade risk here, of course, is that previous seasonal patterns don't necessarily repeat themselves each year, and perhaps some incoming US data will alter the expectations for the path of US rates, and potentially the US could avoid a recession. Remember, don't just trade it, seize an exit.